Culver, and this is intended to be a very brief overview of taxation at a very high level. Throughout the course of the term, we'll be looking at the details of taxation, so a lot of the specifics, but I wanted to start with just sort of a high level look at how things are structured and some of the terminologies and issues that come up when we think about taxation. So the first thing that comes to mind for me is this idea that it's an incredibly complex subject. So I'm sure you're familiar with Albert Einstein, but one of the quotes that's attributed to him is the hardest thing in the world to understand is the federal income tax. And when Einstein has a tough time with it, I get a little bit intimidated because it seems like it might be beyond my ability to comprehend all of it. And what we see from a practical standpoint is very few people understand all of the tax code. Eventually, people tend to specialize or become experts in certain areas of it because it is just too immense. I think it was the Taxpayer Advocate's Office, or whatever their appropriate name was, that in 2010 kind of looked at the tax code and estimated that it was 4 million words. So, fortunately for you, we're not going to read all of it. But it's a large and cumbersome endeavor to try to study taxation, and so we'll do our best to try to focus in on the things that are pertinent to individuals and businesses, and try to look at the things that come up most commonly. So we'll be focusing our concerns on items that are more broadly seen as opposed to specialized areas. So I guess the other thing to think about here is that taxation is a significant expense for both individuals and businesses, which is why it is worthy of some study. Uh, so this little slide or graphic here depicts that a lot of individuals work basically from January 1st to sometime around tax day, or approximately a third of the year, or a little less than a third of a year, to pay their tax obligations. And so when you start to have an expense that is that significant in nature, whether it be, let's say, your business, and whether it's payroll expense or fixed asset expense, or in this case, tax expense, it becomes important to know something about how that expense works, operates, how it behaves, and how we might positively impact that expense so that it's not quite as significant. And so one of the things we'll talk about a bit later is tax planning and trying to reduce our overall tax obligations. So let's back up for a minute and think about where the tax code comes from. And so you may remember, back in elementary school or middle school or high school when they talked about law creation. And if you're as old as me, you may remember the little Saturday morning cartoon about how bills are created. I won't try to sing that cartoon for you because that would just be too much. But the tax code is brought to us by Congress. Oftentimes it is proposed or offered up by the president, but it really begins in the House Ways and Means Committee and also in the Senate Finance Committee. So members of the House, at the urging of the president or by other parties, will create tax legislation in the House. And that will be created at the committee level to begin with. It may involve proposals, studies. There may be, studies from the government in terms of both financial accountability and what kind of revenue is going to be raised, who's going to be impacted, all these various features. But eventually, some kind of draft legislation will come out of the House Ways and Means Committee. It will then likely go on to the House floor, where it may be subjected to a vote, and the entire House, if it is so inclined, may approve some legislation, at which time then it will traditionally go on to the Senate Finance Committee, where the Senate Finance Committee will take it up. They will have their own committee meetings, possibly hearings, additional studies, whatever needs to happen. And then the Finance Committee may approve something that looks like what the House did, but it may be something somewhat different. Then once that leaves the Senate Finance Committee, it would likely go to the Senate floor. It may be subjected to amendments just like it would have been in the House. Then the Senate as a whole may approve the legislation. Now, it's often quite likely that the legislation approved in the House and the items approved in the Senate may not be the same, so it may go then to a joint committee on taxation where there will be some committee of both House and Senate members that will get together and try to reconcile or merge their two bills that are slightly different into a single bill. In which case, then that would go back and would need to be approved by the House and Senate in its new revised forms without amendment so that they can stay the same. And if all of that can happen, then it can be off to the president for a signature and can become part of the new tax code. One of the things that's kind of interesting here is the tax code is used in a lot of different ways, and you can see on the slide here I've listed social, economic, and political. These are the primary reasons or the different things that we're trying to accomplish with the tax code. So one step above those, the first thing that we're trying to do is there are things that we want to do collectively, build highway systems, take care of national defense and a variety of other particular areas. So there are collective things that we want to do, and we need to raise revenue for those obligations. And it's always an ongoing debate about what role government should play in terms of what types of things should government be involved in and provide, and which things are better left to some other segment of the economy or the individuals. And then once you decide that there's something that needs to be handled by a government entity, then the next raging question becomes, well, who should pay for that? So there's always this debate about whether or not this is an appropriate role for government, and then once we've kind of agreed upon that, or maybe not agreed on that, but come to some conclusion on that question, then the question arises, well, who should pay for these various endeavors? So besides that main question of whether or not it's an activity or a role for a government, there's a lot of other things that we try to do with the tax code, which is in a large part what probably makes it fairly complex or burdensome in terms of the total number of words that we have to deal with. And these goals are the social, economic, and political goals that get embedded into the tax code. So let's talk about some social goals that we have. For example, we generally encourage home ownership. So we provide a deduction for home mortgage interest, and as well as a variety of other tax incentives to try to encourage home ownership. And this is in some ways, this is a social goal. We find that social science has shown that people who are homeowners commit less crimes. They are more stable. They tend to be more economically viable. They're less likely to be revolutionary, I guess. And so that's an example of a social goal where we're trying to get people to behave in a particular way. Another example of a social goal is we feel like it would be good if people supported charitable endeavors, and so we have a deduction for charitable contributions. And so these are examples of things that we're trying to accomplish in the tax code that are somewhat social in nature. In terms of economic things, one of the things that we're always trying to do with the tax code is to grow the economy with the idea that a rising tide lifts all boats and creates more prosperity and opportunities for people when the economy is growing. And so we do a lot of things in the tax code to spur capital investments by changing or altering how we deal with depreciation from time to time, giving immediate expense deductions, to try to encourage capital spending. And then also there's, one of the arguments or debates is that we should lower tax rates because that increases the amount of money that circulates in private hands, which in theory would result in consumer spending or capital investment, which are both thought to be somewhat good for growing the economy. You will see play out here before too long a debate about what the federal corporate tax rate should be, because the U.S. federal tax code at the corporate level has a higher marginal tax rate than many of the other nations. And so there's an argument put forth that we need to lower that corporate tax rate to create incentives for business formation and business expansion at the corporate level. And that is an economic argument. And so social, economic, and then now political, there are some things that are done in the tax code to, I would say, basically to try to either generate votes or to appease a particular special interest group. So one of the weird ones that comes up, if you've studied accounting at all, we have Social Security and Medicare tax. And for the longest time, that Social Security and Medicare tax, it pretty much hit all wages. It hit self-employed people. It was a very broad-based tax. It was very difficult to avoid that tax. But one of the exclusions to that tax originally was railroad workers. And the railroad workers were excluded from that tax because at the time that it was created, it was so old and so long ago that the railroad industry had a significant amount of power, and so they could lobby for that particular exemption. You'll find above the line a deduction for K through 12 teachers for their school supplies up to an amount of $250. And to me, this seems like a largely political endeavor to try to win the favor of K through 12 teachers. You could argue that it's really to promote and support education, but most of those people are in a 15 to 25% tax bracket, so that $250 deduction is almost not worth the cost in the tax code in terms of the line on the form and the difficulty of interpreting it. So this is a bit about how the tax code is created and a little bit about the socioeconomic and political implications that sometimes drive the complexity of the code. So with that in mind, what you're looking at here now is the structure of the federal income tax. And I am not a fan of memorizing things at all, but this formula here is something that you really need to kind of grasp. So we start with income broadly conceived. We have some deductions that everybody can take that we refer to as deductions above the line, or deductions for adjusted gross income, and adjusted gross income will be abbreviated as AGI in most cases. So those are deductions that are on the front of the 1040 that any taxpayer can have access to. That gets us to adjusted gross income, again abbreviated often as AGI, which tends to be the bottom line on the 1040 and the top line on the second page of the 1040. That's income minus deductions. And then we either take the itemized deductions or the standard deductions. The standard deduction is based on your filing status, which will be one of the next things that we'll take up in the course. The itemized deductions are determined by a calculation or a summation of your itemized deductions on Schedule A. Then you get some exemptions, both a personal exemption and then exemptions for your dependents. There will be some discussion of identifying what a dependent is and when they meet the definition of being a dependent later. And so those two things give you subtractions, which get you then to taxable income. Then you are taxed based on your marginal tax rates, which we'll get into in the next slides. But it is a progressive tax system where people who are making more income are paying higher taxes. Then that gets us to your tax liability. And then you may have some credits that you can take, which could be a dollar for dollar reduction in your tax obligation, or you may have made contributions towards your tax by having amounts withheld from your paycheck or by having contributed quarterly estimated payments. And then ultimately, then we arrive at the tax that you owe or your refund. Now, this formula, I guess it's very important because one of the things that we'll have to do is we'll have to identify deductions above the line and compare and contrast those with deductions that go on the Schedule A, and then also be familiar with the various credits that we may be able to take advantage of. And so it will also find that the Form 1040 is structured or organized or basically follows this formula. And so both the way the tax code is written, the way the tax code is implemented in terms of the forms on the 1040 and the processing revolve around this particular formula. So it's the structure that things are organized into. So I said just a moment ago that the tax code is progressive. So here you can see a tax bracket for a single person. And remember that not all of their initial income is going to be taxed at all. Let's say you just had a $3,000 worth of income. You probably would have zero tax because your standard deduction, which is a subtraction, and your personal exemption, which is a subtraction, would wipe out that income. And so depending upon your filing status, you may be able to wipe out maybe on the low side around $9,000 worth of income before you're subject to any tax. And if you're married filing joint, then it's a much higher amount. And so there's some amount that is not taxable because of the various deductions that you have. But once your taxable income gets beyond those levels, then what we see is the first portion of your income, 0 to 9,275 in this case, is taxed at 10%. And then as we go up, the 0 to 9,275 is still taxed at 10%, but then the amounts above that in the second bracket, for example, are taxed at 15%. And so these brackets lead us to the marginal tax rate. And the marginal tax rate is this idea of, or the idea that, or is a term that's used to describe the tax on the next dollar that you earn. So if my taxable income is $190,150, then my marginal tax rate is 28%. But when I earn that next dollar, so I get that dollar that takes me from $190,150 to $190,151. That $1 is going to lose 33 cents because it is crept into the next bracket. All the dollars below that are going to be taxed at a lower rate, but that last dollar is taxed at the 33%. And this becomes an important idea for tax planning because when we're doing things around the margin, it's the marginal tax rate that's going to have an implication. We'll spend some more time with this tax bracket and see this play out quite a little bit when we start working with actual tax returns. So again, here's the marginal versus effective tax rates. So marginal tax is the tax on the next dollar. So if my taxable income is zero, then there is no marginal tax rate. Or if my income is such that my personal exemption and my standard deduction wipe out my income, I may have no marginal tax. But then I could have a marginal tax of 10, 15%, and on up into the various brackets. Because the tax code is progressive and not all of my dollars are taxed at the same rate, and also because I have these deductions and exemptions and possibly even credits that I could take advantage of, and later we'll find that there may be income that's not included in income for taxation purposes. Because there are these various things that take place, my effective tax rate, that is the total tax that I pay to the government divided by all of my income, is going to be a lot lower than my marginal tax rate. And so one of the things that we find is many taxpayers have an effective tax rate for federal income tax purposes below 10%. As a matter of fact, if you have an effective tax rate above 10%, you probably have either very high income or you're just not taking advantage of any um, deductions or anything in the tax code. It's pretty common for your average, let's say, two income, low to middle income taxpayer to have effective tax rates, I would say, in the 6 to 9% range. It's just, rough estimate. Everybody's situation is unique, but that's where I would find kind of the bulk of the taxpayers coming in. Now, tax planning is the idea of trying to attempt to reduce your effective tax rate by legal means, by taking advantage of the deductions, credits, non-taxable income, by basically making decisions that help to reduce your effective tax rate. And we'll get into in a moment the difference between avoidance and evasion and tax fraud. Here is effective tax rates based on income categories. Now, this table is old. You can see that it's 2007, but there haven't been, I don't think there's been changes in the tax code that would significantly alter this distribution. And you can see, when I was talking about, income, say, just look, for example, between $30,000 and $75,000, you can see that 6 to 10% range where people's effective tax rates are down lower. And you can see that as your income becomes lower, your effective tax rates are even lower amounts, and then you can see they jump up as you get into higher income situations. So you can see that the tax code is indeed progressive, that people who have higher incomes make larger contributions to our federal expenditures. Now, we need to distinguish here between tax avoidance and tax evasion. So tax avoidance is this idea of legally trying to take advantage of excluded income, deductions above the line, deductions below the line, credits, and doing tax planning things that you can do. Tax evasion is breaking the law or cheating. So there is a lot of things that you may be able to take advantage of, but in order to do that, you have to be knowledgeable about the benefits in the tax code that might work for you, which is why, of course, you take a tax class. Tax evasion is just simply cheating, lying, falsifying your income, faking deductions. And we need to distinguish here between, tax errors and tax fraud. So you may accidentally take a deduction or a subtraction or a credit on your tax return thinking that you qualify for it when you really don't. That's an honest mistake. That's an error. That is something that can subject you to interest and penalties when it is discovered and corrected by the IRS, or corrected by you if that happens to be the case. That is different from the situation where you willfully and with intent try to take something that you know you're not entitled to. That's the definition of tax fraud. And so when a taxpayer makes a mistake, it's interest and penalties. When a taxpayer does it intentionally, then it's tax fraud, and then it's interest and penalties, and then much more significant penalties, and the possibility of jail time in fairly rare circumstances. But it does happen, and every so often I think it's, the IRS likes to process a certain number of tax fraud cases just to remind people that there are consequences for egregious and unlawful behavior related to your tax return. But this shouldn't deter you from taking the deductions above and below the line and the credits that you're entitled to. And you shouldn't be fearful of just making a mistake, because a mistake does happen as long as you weren't doing it with intent, you were trying to comply. Then again, you probably have interest and penalties, but nobody's going to come knocking on your door looking for you. So this is an interesting graphic here, and I throw this out, or I close with this idea because I believe this is the fall of 2017, that we're about to have significant national discussions about tax reform. And although, once again, this graphic is fairly old, I just recently read a a very current book, and the graphics are pretty much the same. And you can see that the United States is a fairly low tax jurisdiction in terms of total tax as a percentage of GDP, and that there are other, primarily European countries that have, developed economy and are collecting a lot higher amounts in terms of taxes. One of the things that's difficult in this graphic low is that um, in the United States, we spend 19 to 20% of our GDP on healthcare also. So if you were to look at the U.S. Tax collections and then the healthcare costs that all of us pretty much incur, we would have spending that was pretty much on pace with some of the highest taxed jurisdictions in Europe. And so one of the things that we have to do when we evaluate these things or we look and think about them is we have to look not only at the tax that's being collected or the tax that's being paid, but also the services that are being delivered by that particular nation. And so I guess I will just close here by encouraging you to ponder or think a little bit about tax policy. And we, of course, are focused at the federal income tax level, but we have estate taxes and um, state taxes and gas taxes and other excise taxes, taxes on cigarettes. Some municipalities have taxes. We have fees and fees for services and whatnot. And so all of these become part of an entities, whether it be a local government or a nation or the federal government in this case. It all becomes part of their tax policy. And these policies have implications both in terms of what services we provide and who's going to pay for those. And that debate is going to, I think that debate's been going on as long as we've had society, and I think it will go on for a long time. But I think we're at a position right now here in the fall of 2017 where that debate is going to ramp up. And I guess, it's my preference not to engage in that or to think about that from a political standpoint, but to think about that from a tax standpoint and what would be good tax policy, what would be efficient in terms of the collection of revenue, what would be effective in terms of providing good services, what should the tax base look like, should the rates be different than what they are, should the tax code be more progressive or less progressive than it is. And I would encourage you to steer clear of the political debate because we've all got enough of that junk on our Facebook feed. But I think as you go through this class and as you start looking at some of the particular details of the tax code, which there will be a lot of them, I would encourage you to, kind of step back from the details every once in a while and kind of say to yourself, well, why is it that we're providing this particular deduction, or why is it that these things are the way they are? Because that is a really fascinating and interesting both conversation and a thing to think about, at least, if you're a nerdy accountant like me. Thanks for tuning in. Take care. Bye.